Hello and welcome. You are listening to Microwaves, the podcast of the economic research of BNP Paribas. 3 times a year, the Advanced Economies team of the Economic Research Department publishes its EcoPerspectives. This is an opportunity to take stock on the situation of the major advanced economies, namely the United States, the eurozone and its main member countries, the United Kingdom and Japan, and in particular to update their growth forecast in the light of specific risks. I am Marianne Müller, economist for Europe in charge of Germany, and we are joined today by Hélène Bochon, Deputy Chief Economist and Head of Macroeconomic Research, and Lucie Barrette, Economist for Europe in charge of Southern Europe. Hello, Hélène.
Hello, Marianne.
Hello, Lucie.
Hello, Marianne.
The economic news at the beginning of the year has been dominated, if not overshadowed, by Donald Trump's announcement of new and significantly higher tariffs on import of goods into the United States. Several countries have acted proactively to avoid escalation or to put an end to it, as in the most recent example of China. In this context, the United States has decided to suspend the entry into force of additional reciprocal custom duties for 90 days and to use this time to conclude any bilateral agreements. In the meantime, it is important to bear in mind that these custom duties, while they have not come down from their peaks, remain at significantly higher levels than before Trump's return to the White House. Moreover, uncertainty remains very high, and as a result of which the downside risks to activity persist. In this new podcast, we are taking a look at the short to medium-term economic outlook for the major advanced economies, analyzing the impact of trade tensions, the room for maneuver available, and the expected economic dynamics. My first question is to you, Hélène. What is the main impact of the recent US tariff announcement on the global economy?
Well, although it is difficult to anticipate all the consequences in both the short and long term, there is no doubt that these announcements will have negative effects primarily for the United States. Generally speaking, the tariffs announced are likely to lead at the very least to a slowdown in global demand and to a reorganization of trade links and international supply chains in order to provide the best possible protection against the shock of US tariffs, with potentially lasting effects on trade flows. The erratic and unpredictable nature of the announcements is also fueling global uncertainty. Although there are signs that trade tensions are gradually easing, notably with the 90-day pause announced by Donald Trump on 9 April, the agreement recently signed with the United Kingdom, and another 90-day pause negotiated with China on 12 May, the context remains extremely uncertain, with major and lasting negative effects on activity.
Lucie, my first question to you is general, but a very important one. Can Europe withstand this tariff shock?
Yes, absolutely. The European bloc seems to be relatively well positioned to withstand the negative shock coming from the United States for 3 main reasons. Firstly, its budgetary flexibility at the European Union level. Secondly, its room for maneuver in terms of monetary policy. And thirdly, its ability and willingness to stimulate domestic demand through investment.
I assume you're referring to the German investment and the rearmament effort expected at the European level.
Yes, exactly. Generally speaking, even if this significant increase in defense spending in Europe will take time to materialize, it should boost confidence in the short term. It should also offer new opportunities to sectors facing declining demand in their traditional markets. Germany, in particular, will be able to reorganize its industry by relying on its strategic sectors and transferring production capacity from struggling sectors, such as automotive and chemicals, to its stronger ones, such as military equipment, metals, and electrical and electronic equipment. Ultimately, this redeployment should have a positive impact on European growth in the medium term, without adding inflationary pressures.
We're entering a new era as the global economic system that has operated for the last 80 years is being reset. Since late January, many tariff announcements have been made, culminating on April 2nd with near universal levies from the United States and counter-responses from some trading partners. The US effective tariff rate has surged past levels reached more than 100 years ago, while tariff rates on the US have also increased. Beyond the abrupt increase in tariffs, the surge in policy uncertainty is a major driver of the economic outlook. If sustained, the increase in trade tensions and uncertainty will slow global growth significantly.
What are your growth forecasts?
I am going to start by presenting those for the US economy, mentioning first the sudden reappearance of the risk of a recession, which we believe has a 25% probability of occurring. This is therefore not the central scenario we have adopted, which anticipates a sharp slowdown in US growth, falling to an annual average of 1.3% in 2025 and 1.2% in 2026. Note that this forecast for 2026 has been adjusted slightly upwards compared to what was published in our EcoPerspectives following the publication of the figures for the first quarter. The US economy would escape recession on the assumption of tariff de-escalation, which appears likely, as mentioned in the introduction, accompanied by less uncertainty, a condition that is at least as important as de-escalation. Otherwise, recession would become the most likely scenario in the US. On the other side of the Pacific, let's look at what's happening in Japan. The country is heavily exposed to the United States, which is the primary destination for Japanese exports of goods, and China is the second largest destination. As a result, we have lowered our forecast for 2025 to 0.7%. For 2026, we expect growth of 0.2%, so a very small but positive figure.
Lucie, what are the forecasts for Europe?
In the eurozone, before April 2, which is the Liberation Day and the date of the shock announcement of reciprocal tariffs, the economic outlook had improved due to the previously mentioned announcement of future increases in military spending in Europe. This is a significant factor in supporting growth, fueled also by the feeling that the European Union's calls for action have been heard. Nevertheless, the worsening of the post-Liberation Day tariff shock has led us to revise our growth scenario for Europe. In the short term, the impact of higher US tariffs is likely to have a greater negative impact on European growth than the gains from increased defense investments and the knock-on effects between countries, as these gains will take longer to be felt. As a result, we are forecasting growth of 1.1% in 2025 in the eurozone. This figure is slightly higher than that presented in EcoPerspectives, as it takes into account the good growth figure for the first quarter of 2025. However, a slight improvement is still expected between 2025 and 2026, despite the US slowdown, thanks to the rise in defense spending in Europe and the German investment plan. For 2026, we therefore expect a growth of 1.2% compared with 1.3% in EcoPerspectives, which is similar to the growth rate expected for the US. This is noteworthy. This expected convergence in growth rates between the US and the Eurozone by 2026 is an important feature of our scenario. Finally, for the United Kingdom, average annual growth is slightly lower, but relatively less than in the Eurozone, as the country has been less sanctioned than its European neighbours. We therefore anticipate growth of 1% in 2025 and 0.8% in 2026.
Thank you for this overview of the growth outlook. Now let's move on to the inflation. Is the same convergence scenario expected?
Not at all. And this is another important marker for our forecasts. The current outlook for inflation on both sides of the Atlantic is very divergent. According to our forecasts, US inflation will visibly start to pick up from the third quarter of 2025, peaking at 4% in the second quarter of 2026. On average, US inflation would rise to 3.1% in 2025 and almost 4% next year in 2026. This increase is a direct consequence of the tariff shock. In our forecast, it is not the result of a self-sustaining inflationary mechanism as in 2021-2023. From this perspective, it is temporary in nature. Nevertheless, a more pronounced slowdown in the US economy or even a recession could help to moderate this inflation bump. Similarly, the current fall in oil prices is a favorable development that will push down US inflation, at least in the short run.
I'll take over from Hélène to continue with the eurozone. We still expect disinflation to continue and a return to the 2% target. The domestic components are disinflationary. And on the non-domestic side, inflation imported from the US and the extra costs arising from friction and reorganization of supply chains should be offset by 1. The strengthening of the euro against the dollar, 2. The absence of any major retaliatory measures, and 3. Disinflation or even deflation imported from China. In 2026, according to our forecast, headline inflation will even fall slightly below 2% on an annual average.
In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments.
Downside risks to economic growth have increased. The major escalation in global trade tensions and associated uncertainties will likely lower euro area growth by dampening exports, and it may drag down investment and consumption. Increasing global trade disruptions are adding more uncertainty to the outlook for euro area inflation. Falling global energy prices and appreciation of the euro could put further downward pressure on inflation. This could be reinforced by lower demand for euro area exports owing to higher tariff and a rerouting of exports into the euro area from countries with overcapacity.
Converging growth rates, diverging inflation trajectories. What does this mean for monetary policy? The task seems more complicated for the US Federal Reserve than for the European Central Bank, doesn't it?
Yes, indeed. And this leads us to anticipate divergent monetary policy developments on both sides of the Atlantic. On the US side, the Fed has to navigate between upward risks to inflation and downward risks to growth, and has to manage a stagflation-type situation. In our scenario, these two risks cancel each other out, and we believe that the Fed has no choice but to maintain the status quo on monetary policy, which it would extend until the end of this year. The risk of a de-anchoring of inflation expectations also comes into play and explains why we believe that the Fed will not be able to look through the expected rise in inflation and cut rates in response to the slowdown in activity. As long as this slowdown remains contained, it does not call for rate cuts. In 2026, however, the Fed would be in a position to resume rate cuts as the inflation growth trade-off shifts in favor of the latter.
Compared to what Hélène just said about the difficulty of the Fed's task, for the European Central Bank, the situation is more favorable, both in terms of inflation and growth, and the conditions remain in place for further rate cuts in the short term. We continue to anticipate 2 further cuts in June and July of 25 basis points each, to reach a terminal rate of 1.75% in July. In 2026, however, in the second half of the year, the expected strengthening of growth combined with the inflationary nature of the rearmament effort would lead to the ECB to raise its rate by 50 basis points according to our forecasts, which will accentuate the decoupling from the Fed. In the United Kingdom, the Bank of England faces a more complex situation as inflation is higher and the economic situation is difficult. According to our forecast, this would lead the BOE to continue its easing at a slow pace of 1 cut per quarter, spreading it out until early 2026. Finally, the Bank of Japan, which has been very cautious in raising its key rates, would move closer to its peers by pausing its adjustments for the rest of the year. This would therefore be a status quo like the Fed, but for different reasons. In Japan, concerns about growth are predominant. Once these concerns have passed, the Bank of Japan is expected to resume its cautious rate hikes in 2026.
To conclude this discussion, what can you tell us about the risks associated with these forecasts for the United States first and then for the eurozone?
Well, in the United States, the tariff shock and the associated climate of uncertainty and financial volatility are fueling the risk of recession, which we have already mentioned, particularly by weighing on confidence, business and consumer confidence, and as well on investment and hiring intentions. We believe that downside risks are prevailing, but we cannot rule out a more favorable scenario thanks to the strong starting point of the US economy and in the event of a greater than expected easing of tariffs. The Trump administration's plans for tax cuts could also support growth, provided, however, that they do not create too much additional pressure on long-term interest rates given the scale of the US fiscal deficit.
In the eurozone, we can identify upside risk to inflation. According to our scenario, as growth strengthens, supply constraints could reappear and put upward pressure on inflation. Moreover, although the German fiscal turnaround and rearmament effort in Europe should stimulate growth, they are not without their difficulties. In addition to the challenge of implementing them as quickly as possible, they are colliding with a major budgetary challenge, that of reconciling and finding a balance between several current priorities: increased public defense spending, investment in the energy transition, and expenditure related to the aging population. All of this would be done against a backdrop of higher interest rates, with many countries still having high ratios of public debt to GDP and limited growth prospects in most of these countries and elsewhere. There is therefore a clear incentive not to relax budgetary discipline in those countries where budgetary imbalances are most significant by reducing primary deficits. The challenges are considerable, but we believe that Europe will rise to them and emerge stronger from this ordeal.
Thank you very much, Hélène, and thank you very much, Lucie. We thus retain for this quarter the two major turning points. On the negative side, the neo-protectionist shock of the US tariffs, and on the positive side, the European rearmament and investment efforts. The only certainty is the uncertainty surrounding their repercussions. But major changes are likely to be underway, and your team will be keeping a close eye on them. We invite our listeners to follow the future developments on our website. Thank you for following us, and we see you soon for another podcast.